Hi everyone, welcome to OCBC Research Insights. In today's video, we want to discuss our house view on the global economy, as well as implications on the rates and FX. My name is Tommy Hsieh. I'm the economist of the OCBC Bank. Together with me today, we have our chief economist, Selina Ling, rates strategist, Francis Chong, and FX strategist, Chris Wang. So at the start of 2023, I remember, the global recession is the most hot topic in the market. But 2 months later, things has changed quite a lot. Selina, can I ask you, what has caused the changes? In your opinion, are we able to avoid a hard landing scenario?
Tommy, this is a very interesting observation because in our client seminars at the start of the year, when we polled the audience, I would say more than 60% of the audience expected that a recession was imminent. And when I do the same poll over this last 1 to 2 weeks, the percentage has actually dropped to less than 1/3 of the audience. So it is quite a sea change. And I think there are two main factors that are contributing to this change in mindsets. I think first is in terms of China's reopening. Essentially, we are starting to see that the post-exit wave of COVID infections has probably peaked in early January and come off. And since then, actually, Chinese consumers have been out and about. They have been spending and eating and shopping. So that's a great start to the reopening story. And I think the February PMI numbers also suggest that economic activity is actually rebounding rapidly in China. So that's actually good news for regional economies apart from China itself. The second factor really is that recession risks that are perceived in the major economies like the US, Eurozone, and also the UK are subsiding. So at the start of the year, people were looking at recession risks in the US in the 60+ percentile, UK and Eurozone in the 80 to 90 percentile. These have come off quite sharply. It is still a lot higher compared to a year ago when the percents were already in the teens. But nevertheless, it shows that recession fears formally have peaked and are slowly subsiding. So what's driving this wave of optimism towards the major economies? Because economic indicators have suggested that actually some of these economies like the US is very resilient. So we got better than expected North of Euros, ISM numbers, and also for the Eurozone because they had a mild winter. So the energy crisis didn't take such a big chunk out from the fourth quarter growth. So I think there is a little bit of a turnaround story from here. The UK is probably still going to see a recession this year, but I think there is a sense that it's not going to be as bad as what was initially anticipated. So your question about does it mean that we should forget about the recession concerns for the rest of this year? I think not quite yet. Like I said, compared to a year ago, actually the recession probabilities is still a lot higher, although they have come off their recent peaks. And I think the key risk here really is that overzealous central banks, like the Fed for instance, and we get the ECB as well, that because they see demand conditions as being fairly resilient and financial conditions being too loose, and this complicates their ability to bring down inflation back to their target range. So they may actually continue to hike and hike more than what market is expecting. So this in turn could actually precipitate the next downturn. So I think the key risk here is that as market shifts from a hard landing to a soft landing story, and maybe a no landing as if the economy is keep on going, then we could get overzealous monetary policy there.
Yes, so I think very positive improvements in terms of where we are in terms of the economic growth. But again, as you mentioned, I think that makes the central bank's job more complicated right now at the moment. Now the interest rate market, has repriced to the hawkish side. So Francis, I remember in the beginning of the year, we have a discussion, for the 10-year US Treasury yield, whether they will hit the 4% first or 3% first. Now we have the answer. What do we see the implication on the rates markets and the bond markets?
Yeah, Tommy, I think as Selina mentioned, where we have a slew of better than expected prints of economic data, in particular the inflation data. These outcomes have strengthened the higher for longer narrative. So we have the interest rates market already repriced the expected peak Fed funds rate higher, and at the same time also reduced the interest rate cut expectations. So our base case is 3 more rate hikes from the FOMC, each of which would be likely of a magnitude of 25 BP, and these would bring the terminal rate to 5.25% to 5.5%. Bond yields also rose alongside these hawkish repricing. And if you look at the 2-year Treasury yield now, that is roughly in line with the already more hawkish market expectations on the Fed fund rates over a 2-year time horizon. So in other words, we do not see too much dislocation in the pricing from here. So chasing the front-end yields higher at this juncture is not preferred until we see a fresh round of data which shows surprisingly strong inflation outcome. So should inflation persist, of course, we would believe that the Fed hiking cycle will be extended. Between smaller rate hikes and bigger rate hikes, the Fed will probably choose to go with the 25 BP kind of clips because of the very high uncertainty on the inflation outlook. If they go for smaller rate hike each time, that would allow more flexibility for them to assess the impact of the previous tightening. And looking even further ahead, if the likelihood of this soft landing scenario become increasingly higher, then the yield curve should also become less inverted.
So basically, we expect 3 more hikes, right? But we try not to chase the short end too much in the near term. Chris, the higher for longer narrative has caused some kind of the dollar short, unwinding of the dollar shorts. So however, it's worth noting that this repricing is not only limited to the Fed. In fact, a major of the global central banks are facing the similar kind of the repricing. So does this change your view on the US dollar, and what's your view on the dollar in the near term and in the medium term?
Yes, you're right, Tommy. The hawkish repricing of central bank is not just limited to the Fed. You're seeing it at the RBA, the RBNZ, and the ECB as well. Basically, these central banks are all trying to combat inflation expectations. So what this means is that, you've got a higher for longer situation that can potentially undermine demand, and that can also affect sentiment. So some of the currencies that could come under pressure in the interim could include the Korean won, even the renminbi as well, and to some extent even the Taiwan dollar. But if you were to look on the other side of things, you've got some central banks that potentially have already shifted to a hawkish stance, like I mentioned earlier. So there could be a bit of resilience on these currencies as interest rate differentials can potentially help to mitigate some of the differentials against the US. There could be a risk, a scenario, if we do get this unfortunate event, US potentially reverting back to a very aggressive pace of tightening, so in clips of say 50 or even 75, if you recall last year, then this situation could potentially undermine sentiment further. But if I can just briefly summarize, the short-term view for the dollar is that there could be a bit of consolidation at this period, but over the medium term itself, we should expect a bit more of this dollar softness to come in, potentially from second quarter onwards, where we could see this China reopening thematic gather a little bit more traction.
Thanks, Chris, for your view as well. Thanks all. So basically, we are seeing the better improvement in terms of the growth data. But of course, certainly that will make the central bank's job more difficult, right? So we do expect the higher for longer theme to continue, and we do expect the interest rate to maybe another 3 times hike towards the 5.25 to 5%, 5.5% for the US Fed. In terms of the impact on the FX, I think as mentioned by Chris, in the near term, the dollar may still seeing some kind of the consolidation, but the dollar softness may eventually still kick in as early as the second quarter of this year, because the current repricing is not only limited to the Fed, it's the global repricing we are seeing. So that's the house view for OCBC Global Treasury Team for now. So if there's any change of the house view, we will keep you updated. Thank you for watching.